Hello, everybody, and welcome to Money Matters. If you like to make money and enjoy learning about crypto as well as other investment topics, please subscribe to the channel. If you enjoy the content, like this video, hit that like button as well. Let's get going. As always, I am not a financial advisor, nor do I give financial advice. Let's take a look at the market. Well, although it's red, you can see that it's little reds, not big reds, so not too bad. I think we've kind of slipped into a resting period for the market after our tumultuous last week, and we can sit down and enjoy it. Just relax, take it easy. I think it's going to be like this for quite some time. My guess is, as I stated yesterday, that we're probably going to be consolidating in and out of that high 30, mid 40 range for quite some time. So take a break and take a deep breath, but not for too long, because as you know, in crypto land, things change very quickly, and sometimes it can be pretty surprising. So enjoy the downtime, study your portfolio, start working on your exit plan, and stick to it. Let's take a look at the news. The SEC has started to look at a couple of other Bitcoin ETFs, which isn't a surprise. They have, I want to say that there were 6, 2 were denied, but there were 6, including the 2 that they added today to the list that they're looking over. I don't know if June is going to be the month that they give the okay, but my thought is that the first one will go to Grayscale, being that they're the largest single holder. I think they hold 4% of all Bitcoin, if I'm not mistaken. I'm pretty sure that's correct. But they'll probably grant them the first ETF, and then there'll be a cascading waterfall of them shortly thereafter. Probably after the first handful of Bitcoin, there'll be some Ethereum ones added as well. And my guess is that the Ethereum is going to be just as in demand as Bitcoin. So once those hit the market, we'll have a really easy on-ramp into crypto land from baby boomers, people who have tons of money in the bank that would really like to get some exposure into crypto. So it's been in the works for quite some time, should be happening soon, and it will affect the price, and it will certainly affect the demand, because the demand will go through the roof at that particular point in time. Speaking of the SEC, Gensler was talking about adding some, and he's a pro crypto guy. He taught over at MIT, and I actually watched some of his lectures on blockchain and cryptocurrency, and they're really good. If you are bored one night and you want to learn about cryptocurrency and blockchain, check it out. It's all free stuff that he did over at MIT. Anyway, he was calling for some protections, basically in the industry, which I will have to agree with. I think that we're getting to a point where things are moving so fast and can happen so quickly that the advantage is tipping to people who have lots of money, lots of connections, and lots of data. If you can see what's happening before other people see it, and you act on it before they do, you're going to win every single time. For example, if you know that there's a ton of orders coming in at one specific point in time, you can actually, if you're using a DEX or something like that, up your gas fee and be put in line, first in line. So you can get your order filled before somebody else's in a lot of different ways. So I think that having some of those advantages taken away and make it more of a level playing field would be a good idea. In addition to that, I think that market manipulation is rampant, and I do think that that needs to be capped ASAP, especially if we want retail investors to survive this, because I'll tell you what, last week was brutal, and it wasn't rich people losing their money, I guarantee. So anyway, I think regulation to some degree would be welcome. In other good news, PayPal and Robinhood have announced that they are going to let folks take their crypto off of their platforms and into their wallets. So I think that was a missing component that they needed to really kickstart business with respect to crypto. And I think that perhaps they kind of did that just to hold assets on house, but really, in all actuality, having that freedom to go back and forth, they're going to see that it's just going to be another profit center for them, especially PayPal. And it's good for customers as well, of course. I think that Robinhood was taking a lot of criticism about it because they're basically an exchange and they're not letting people take, it just doesn't make any sense. So anyway, we should see that coming into play here shortly. And I think it'll be beneficial for both companies as well as for customers. So all good. Okay, today we're going to take a deep dive into Aave, which is I'm going to tell you what it is. Aave is inside the DeFi space, which has come into popularity in the last year, and it's actually a lending protocol. They have a larger market cap than Maker and Compound, which are two well-known names. And I think that they really started to take the lead more in December timeframe. And I think that that was when a lot of folks were becoming really educated on DeFi and kind of saw the benefits of flash loans, which people use for arbitrage and some other crypto type endeavors. That's not really mainstream, but it was a function that allowed people to accomplish some things that they wanted to do. It's the way it works is that people invest their crypto into Aave, and that liquidity or that money is made available to other folks to take out loans against it. When you go to the bank, the regular bank, you have to sit behind the desk and fill out forms. I mean, if you've ever done it, it's a horrifying experience. And of course, you have to have collateral. The simplest example being if you go for a car loan, you get a car loan for $20,000. They typically hold the title to that car as the collateral. So if you don't make payments, then they send, Butch out in the middle of the night with his tow truck and they take your car away, and your credit's ruined and you don't have a car anymore and you have to take the bus to work, and it's just terrible. But with crypto loans, and I've heard some amazing stories of how people are using this. There's this one guy, he has a YouTube channel. I can't remember his name. I think it's Dan something. And he's his big business he's deep into real estate, and he gets a lot of buildings and properties, and then he uses them for Airbnbs. And it was interesting because recently he's been buying properties in Puerto Rico, which I used to live in Puerto Rico. It's a beautiful place, but it's a tax haven for cryptocurrency because they don't collect tax on cryptocurrency as long as you have a residency there. So I think his plan is that he has quite a few properties there, and he calls one as a residence, and he goes down there a lot. So he's actually benefiting from this tax deal. But anyway, the last house, or one of the last houses that he purchased with a crypto loan online. He didn't go to a bank. He said he got it in 15 minutes, and his mortgage was funded in 15 minutes. Can you imagine that? How long does it take you now? You have to send in all your W-2s and blood sample and everything else, and typically they want more after that anyway. And then you're going back and forth about different interest rates and whatever. So DeFi is quite a bit different. There's no bank involved. It's a smart contract, so it's a predetermined contract. The terms are already written into the contract. Your interest rate is going to be just what they say it's going to be, and that's it. There's no human beings making any decisions on whether you're worthy for getting a loan because of your bankruptcy or whatever. If you have what they want, which is collateral, then you're fine. And the little picture here kind of gives you an idea. We're going to delve into this a little bit more in the slides coming up. But it was such an interesting idea, and it's really working out well. And I think this is one of the biggest spaces in DeFi, or one of the spaces that's going to grow to be one of the largest areas. Oh no, I ordered a new clicker, but it's not here yet. Oh, wrong way. There we go. I'll hold it on my lap so I don't have to do that again. Anyway, so how do they get their money? Well, Aave gets their money from people who invest their cryptocurrency, and Aave holds it and provides them with interest payments, so they can make 4%, 10%, 20%. And my understanding is that depending upon liquidity, that's how much money is available for loaning out to other people, is what determines your interest rate, what interest you get on the crypto that you put into Aave. So it could be 5% if they have tons of liquidity, or even as low as 2%. But if they don't have any liquidity and they need money because they need to make loans, they're going to give you 40%, whatever they have to do to get you in the door. That's what they're going to do. So the people who invest get their money or their profit from interest. In addition to that, the value of whatever cryptocurrency that they have is appreciating or depreciating depending upon the market. So if they put in a Bitcoin and it goes up $50,000, they're still going to make that $50,000 on their Bitcoin on top of the interest that they're making as well. And then on the other side, we have people who want to buy a car, or they want to buy a house, or a cool guitar, whatever, and they take out a loan and they have to pay interest in on that loan. So we've used the example of the car, and you have kind of a basic principle of having collateral on the car, but with crypto, you don't have that. They won't take your title and send Butch out to get the car. They can't do that. It's a smart contract. It's not a person. So it works a bit differently. When you purchase, or when you go for a loan or get a loan through Aave, then you have to over collateralize that loan. So in other words, if you get a loan for $500, that covers the amount that you would need to get the loan. But with the fluctuating volatility of cryptocurrency and the value of it, it goes up and down constantly. So having a spot on loan for an exact amount of money is just not going to cut it. So you have to over collateralize it, meaning you have to put more money up as collateral, like $1,000 on a $500 loan. And I think some of them are 40%. I think that's a typical benchmark. You would typically put up 40% more than you're borrowing so that you can cover that fluctuation in value of whatever crypto's in play. Now, there's a problem that comes in with that, in the sense that it's kind of like buying stocks or crypto on margin. So if the price goes too far one way or the other, and your extra collateral's used up covering that loan, they can do a call and say, hey, listen, we need more money from you to cover, not money, but more crypto or collateral to cover your loan. You either come up with it, or we're going to liquidate this loan and take all of your collateral, and you're done. You won't have this anymore. So that's the only drawback. And if you really think about it, as time goes by, when the market starts to level out a lot more, then the volatility that's associated with these prices is going to stabilize, and it's going to be much more predictable. You'll probably be able to get away with like a 10% or 5% over collateralization. And at some point in time, you probably get to a point where there is no additional collateral needed for the loan. You would just have predetermined amounts, predetermined interest rates, and you just pay it for whatever the term is, and you have no risk of this volatility liquidating you and taking all of your money, because they have to do that. If the value of their underlying assets are dropping, they have to cover those variations. So they'll have to come back and get more money from you. Now, there's an important distinction here too. When the initial principle or idea of this type of loan was called peer-to-peer lending. So it would be like me going to you and asking if I could borrow money from you. Oh, I can't do that. I have to have it over here. Damn, I'll get the hang of this. Don't worry. There we go. Okay. I'm sorry about that, folks. DeFi lending, in theory, is peer-to-peer. So you have a lender who is a person. They deposit their crypto into the platform, and they're given, interest for whatever amount they're putting in. And then somebody who wants to borrow the money goes to the app or the protocol, and they borrow the money and they pay interest in. But Aave and all other lenders online do this a little bit differently. They have what's called a pool to peer, which makes sense, because you have a bunch of people that are investing their money into this endeavor, and it provides a lot more liquidity for the protocol as well. So they have a lot more money to lend out, which means more interest, more money. Everybody's happy. So the pool for liquidity is much higher with a lot more people. So it's really a pool to peer, a bunch of people putting money in and then individuals taking money out in a loan. But it all works the same way. Everybody who's in the pool, puts up their crypto as a loan, and then they get interest paid on that crypto as well. Now, the cool part about this is that when they put their money in, they're actually given A tokens, which is the Aave token, and they hold on to those. And they get paid actually in two ways. They get paid in interest on loans, and not just flash loans, any loans. And they also get a percentage of some of the money that is made. So it's really a good deal. And this is where you hear about all this yield farming and stuff like that. It's a big business, and as I said before, it's going to be huge. It's just now starting out. I could see specialized companies popping up that just do car loans, and maybe they have a butch on the side, company that goes and collects cars or whatever to help with that part of the business. I'm not really sure how it would work, but I certainly could envision student loans and all kinds of different things that could be, a specialized area for this type of a company. So it's pretty interesting if you think about it. Now, let's look at Aave from an investment perspective. Can you make money with this? Like, if you're not putting money in to loan to people, which we already know you can make money that way, could you buy it and make money holding their tokens? And my answer would be yes. So I did some brief research. I pulled up a chart, and this is just for this past year. But as you can see in the range that I have in the yellow lines up here, where it typically meanders about, there's a pretty big jump, almost, I'm not gonna say 50%, but pretty close to well, it's almost 100% really if you think about it. But the lows going down into like the 300s and then popping up to like 667 is the all-time high. So everything, of course, is low since it crashed last week. So it's still a good time, in my opinion, and it's not financial advice, but in my opinion, it's still a good time to get in. It's a little bit pricey for me with respect to the DeFi space and the companies that I'm looking to get into, just because of the way I have things spread out. But percentage-wise, this is a solid play. Now, I would also say this: it's one of the major players, and it's only going to get bigger, and it's going to do it pretty fast. So even if you chose it for a longer term hold, I think that you would benefit greatly from that. So it's definitely something that I would put on my radar to hold, moving forward. And again, for me, it would be something that would be a longer hold. Like if there's certain projects that I really believe in, like Near protocol, I really like that protocol, or Solana, of course, Bitcoin and Ethereum, Cardano, Polkadot. Those are projects that I think are going to be around a long time. And of course, I'm betting on the price going up. We're going to do a video on price potential, because I think that there's a lot of misinformation, and people tend to think of things in dollars when they're looking at cryptocurrency, which is not a good thing to do. You really want to look at things in a percentage type way, and you really want to benchmark all of your pricing thoughts in the future on the market cap that a certain company has, because the lower the market cap, the more room it has to grow. The higher it is, the harder it is to go higher. So it's something to consider. And I think that it's an important topic that we need to cover to make sure that everybody kind of looks at that when they're considering investing in a company. And we can break down any company with regards to that too. In fact, it'll probably be a fun exercise to do that in the future as well. So let's do a little bit of a recap. We know that there's already some ETFs stacking up behind the SEC for approval. Hopefully we'll get some word coming out in June or late June to the positive, where they'll say, oh, well, later in the year we can have one, or whatever. I don't know how long it would take to set it up or get it put in place, but I think that it's coming by the end of this year. Gensler's looking to help people out by putting together a package of of protections for customers with respect to trading, especially on exchanges, and leveling the playing field just a little bit more, so there's not such an advantage to wealthy people. And when I say wealthy, not just money wise but data wise, the information that they have available to them and the timing that they have that information available. It's kind of like I mentioned in a couple of videos ago, you've got to get in your research. You've got to understand what these whales are doing. You need to look like at Glassnode and some of these other places to see what's happening, because you can see it happening too. A lot of this information is just free and it's out there. This is a transparent blockchain. You can go and see what's happening. So if you do your research, you can get an edge and kind of ride the coattails or the flippers of these whales as they're swimming through the water. We also spent a little bit of time talking about Robinhood and PayPal. And I think that it's great, especially that they came around so quickly. I know that Robinhood was under a lot of pressure. I think PayPal is just like their crypto exploded, and they're really excited about it. I think this is going to be one of their biggest revenue streams in the future. And I think they're going to come up with some pretty creative ways of using it. I don't know if they'll be like a regular exchange or if they'll go that route, but I definitely think that they're going to have some new ideas that we haven't seen that are kind of like augmentations from PayPal that really are directly associated with crypto and only crypto. And it should be pretty interesting to see that. And we spent a little time learning about Aave today and what DeFi pool-to-peer lending is, and how it's a bit different from banks, and in my opinion, far better. And it will only get better as time goes by and the industry matures. And as I said before, when crypto markets start to level out, which I hope that's not for a while, because that's the fun part of investing. But it will come one day where, and maybe it'll only be certain coins that are used, or maybe they play in certain areas where it's still gives volatility for those of us who want to make money, but it gives stability for those who want to borrow money. It'll be interesting to see. I would love to hear some comments. If you want to put them below, let me know what projects you'd be interested in me covering. I'd be happy to cover any of them. They're all interesting, and I read about them constantly all day long. So I would love to share my thoughts and findings with you. So just drop a comment and let me know. I'd be happy to help. And last but not least, winners never quit, and quitters never win. Always give your very best effort to overcome the challenges that you face in life. I hope you had a great day. I had a great day. I had a really great day. And I will see you tomorrow.